Hello, everyone. I'm Amy.
And I'm Tom. Great to be here. We've distilled a fresh stack of insights from our sources, painting, well, a vivid picture of what's truly moving markets and why.
Mm,
Our mission today is to unpack these updates, highlight the crucial connections, and, help you cut through the noise to understand what genuinely matters for the global economic landscape right now.
exactly. Think of it as a shortcut to being well informed, complete with some surprising facts and insights that might just change how you see the world's financial gears turning.
Okay, let's unpack this. Our sources kick off by zeroing in on a massive piece of legislation here in the U.S. President Trump's $3.3 trillion big, beautiful tax and spending bill.
Yeah.
It's a moniker that certainly grabs headlines, right?
Right.
But it also hints at the ambitious scope of this proposal.
It really does.
Yeah.
And what's truly compelling here is how this bill, which is essentially designed to funnel significant support towards key domestic priorities, actually successfully navigated the Senate on Tuesday.
Okay.
It was an incredibly tight vote, 51-50, with Vice President Vance casting the decisive tie-breaking vote.
Wow, that close.
Yeah. We learned that Senator Murkowski of Alaska, who, had been a notable holdout, was ultimately persuaded to vote for it.
Oh, okay.
After receiving assurances regarding potential cuts to Medicaid and the Supplemental Nutrition Assistance Program, or SNAP.
I see.
This really highlights the intricate dance of political negotiation that underpins such significant legislation.
So for those of us watching the markets, what did we see immediately after the Senate passage? What was the financial world's sort of gut reaction?
Well, we saw some immediate, almost textbook reactions. Gold prices, for example, climbed over 1%.
Well,
As investors reacting to the sheer scale of this fiscal stimulus and, the potential for increased national debt, sought safe haven assets.
right, the uncertainty factor.
Exactly. Think of gold as an old friend investors run to when they're feeling uncertain about traditional financial assets. It often acts as a hedge against potential inflationary pressures
Hmm.
that could arise from such substantial spending. The US dollar also saw an initial advance.
Oh, interesting.
Yeah, reflecting a certain degree of confidence, maybe, in the U.S. political system's ability to push through major policy, despite the narrow margin.
That's a fascinating dynamic. But the Senate is just one hurdle, isn't it?
Absolutely.
What's the outlook for this big, beautiful bill as it moves forward? What are the next big challenges?
That's the natural next question, indeed. All eyes are now on the House of Representatives, and our sources suggest the bill faces a significantly tougher road ahead.
Okay.
There are a number of potential sticking points that could dramatically alter its shape or, well, even derail it entirely.
Like what?
For instance, we're hearing about pushes for deeper federal Medicaid spending cuts, which are, politically fraught,
Always are.
and a more rapid phase-out of clean energy tax incentives, which would face strong opposition from environmental and industry groups.
Hmm.
Then there are revisions to state and local tax, or SALT, deduction agreements.
Salt.
Yeah. For those unfamiliar, SALT deductions allow taxpayers to deduct certain state and local taxes from their federal taxable income. Capping or eliminating these disproportionately affects taxpayers in high-tax states,
Hmm.
often leading to fierce political battles. Beyond that, conservative factions within the House are pushing for even more substantial spending reductions across the board.
So quite a few hurdles.
It's an interesting political chess match, yeah.
Hmm.
And it's even expected to miss the Republican-imposed July 4th deadline for House action,
Oh, really?
which suggests the negotiations are far from over.
Okay. So while Washington is wrestling with the fiscal future, let's turn our attention to the ground truth of the U.S. economy, the labor market. Our sources point to some compelling new data there.
Yeah, what's particularly compelling is the latest job openings and labor turnover survey, or JOLTS report.
Right, JOLTS.
This report is a crucial gauge of labor demand, showing how many jobs are available and how many people are voluntarily leaving their positions.
Okay.
In May, job openings actually increased by a robust 374,000, hitting 7.769 million,
Wow.
which significantly surpassed the 7.30 million forecast.
So much stronger than expected.
Much stronger. This data confirms the underlying resilience of the labor market. For you, the listener, this means that despite ongoing discussions about economic slowdowns or potential recessions, businesses are still actively looking to hire.
Good sign, generally.
It reflects a robust demand for labor, which is, a foundational pillar for consumer spending and broader economic stability.
And how is the Federal Reserve, the ultimate referee of interest rates, reacting to this continued strength in the job market? Does this push them towards a particular decision?
Well, this data undeniably supports the Federal Reserve's patient approach to cutting interest rates.
Makes sense.
Strong employment figures typically signal an economy that might still be running a bit hot, which could reignite inflation if rates are cut too soon.
Right.
Now, the bond market had its own dance with this news. U.S. Treasury yields initially rose on the strong JOLTS report,
Okay.
as investors anticipated the Fed might hold rates higher for longer. However, the Senate's passage of that massive tax bill we just discussed then spurred some safe haven Treasury purchases.
Oh, the counter effect.
Exactly. Which ironically helped push yields back down from their earlier highs. It's a clear example of how different economic signals and policy decisions can create counteracting forces in the market.
Fascinating. So what are traders thinking now about rate cuts?
Well, if we connect this to the bigger picture, Fed funds, futures traders, those who place bets on where interest rates will be, they're now pricing in about a 21.2% probability of a rate cut in July.
Still pretty low for July.
Yeah, up slightly from last week, but still a minority view. What they're really leaning into with the commanding 91.1% probability is a rate cut at the September Federal Open Market Committee meeting.
September seems like the consensus then.
It does. When these traders talk about basis points, they're essentially talking about hundredths of a percentage point. So the market is anticipating approximately 63.5 basis points of cuts by year end.
So maybe 2 or 3 cuts total.
That translates to expectations for at least 2 full quarter-point rate cuts by December, with a little extra wiggle room. It reflects a cautious but clear signal from the market that cheaper borrowing costs are likely on the horizon.
Got it. Which could impact everything from mortgage rates to business loans.
Precisely.
That's a comprehensive look at the U.S.
Let's pivot across the Atlantic, where the Eurozone is grappling with its own set of economic conditions, particularly around the tricky business of inflation.
Right. What's particularly noteworthy here is that Eurozone headline inflation actually reached the European Central Bank, or ECB's, 2.0% target in June.
Oh, they hit the target. Yeah, edging up slightly from 1.9% in May, perfectly aligning with economists' projections. On the surface, this sounds like mission accomplished, right?
Seemed like it.
It certainly reinforces expectations that policymakers will likely pause their rate-cutting cycle at the upcoming July meeting.
Okay.
After having reduced borrowing costs 8 times since mid-last year, it's a significant milestone after a long fight against rising prices.
It sounds like they've hit their bullseye.
Yeah.
But is it truly calm waters ahead for the Eurozone, or are there still some, underlying currents that the ECB needs to watch closely?
Yeah, this brings us to a critical point. While the headline figure is on target, digging deeper reveals a more complex picture.
Oh, okay.
Core inflation, which strips out volatile components like energy and food.
Right, the stickier stuff.
Exactly. That remains stubbornly steady at 2.3%. And services inflation, often a proxy for wage-driven pressures, actually edged higher to 3.3%.
So not quite mission accomplished on all fronts.
Not quite. So despite President Christine Lagarde acknowledging calm waters regarding headline inflation, she wisely cautioned about heightened volatility ahead.
Makes sense.
And there are also significant disinflationary risks emerging. Consider the euro's substantial appreciation, 13.84% against the U.S. dollar year to date.
That's a big move.
Huge. Alongside sharply lower energy costs in euro terms, the euro's strength is a classic double-edged sword, isn't it?
How so?
Well, it makes imports cheaper, which helps lower inflation.
Good.
But it also makes Eurozone exports more expensive and less competitive globally, potentially dampening economic growth.
The trade-off.
It's a crucial factor the ECB has to weigh. The central bank faces a really delicate balancing act, achieving sustainable price stability while simultaneously avoiding an undershoot of its target.
Right. Deflation is scary, too.
Exactly. Avoiding those deflationary spirals that are incredibly hard to escape. It's a tightrope walk for sure.
Okay. Beyond the big policy shifts in macroeconomic data, our sources also highlight some individual market movements and corporate headlines that offer a glimpse into the broader economic currents.
Indeed. We saw a mixed performance in U.S. stock indices yesterday. The S&P 500 and NASDAQ closed lower, even though both actually ended the first half of 2025 at record highs.
Still a strong first half overall, then.
Absolutely. A testament to the rally we've seen. Digging into the sectors, materials was the best performing in the S&P 500, often a signal of optimism for global growth and industrial demand. Conversely, communication services was the worst performer.
Any thoughts on why?
could reflect some repositioning after its strong run, or maybe specific concerns within, the tech and media giants.
And there were some truly notable corporate stories that really illustrate the broader economic environment and the challenges companies are facing. Tell us about a couple that stood out.
Absolutely. One that caught my eye was Ford Motors electric vehicle sales. They saw a significant decline, 31.4% in Q2.
Wow, why such a big drop?
Primarily due to a safety defect identified in its Mustang Mach-E model.
Ouch.
Yeah. This isn't just a blip on an earnings report. It highlights the critical quality control challenges facing the rapidly evolving EV industry.
Right, consumer confidence is key there.
It's fragile. A safety recall can quickly erode trust, making it tougher for automakers to drive adoption, even amidst this broad push towards EVs. It's a stark reminder that even as industries innovate, the fundamentals, like product reliability, remain paramount.
Good point. What else?
Another interesting case involves healthcare. United Health Group and Memorial Sloan Kettering Cancer Center.
Two huge names.
Giants in their fields, yeah. They successfully resolved a contract dispute. This averted what could have been significant disruption for thousands of patients.
That's good news.
It is, but these kinds of large-scale contract negotiations between insurers and providers are a constant battleground, often impacting patient access and healthcare costs. The resolution here offers a sigh of relief, but it also shines a light on that ongoing tension in the U.S. healthcare system regarding pricing and coverage.
Definitely.
And then on the global stage, Renault, they're projected to record a non-cash loss of approximately $11 billion.
Billion. Non-cash.
Yeah, due to accounting changes related to its stake in Nissan. This is a fascinating glimpse into the complexities of international corporate partnerships and accounting standards.
So not real money lost, but still significant.
Exactly. A non-cash loss doesn't mean money literally left their bank account, but it reflects a revaluation of assets on paper, which can still have a big impact on investor perception and future strategic decisions for a major global automaker like Renault.
Okay. Before we wrap up this exploration, let's quickly touch on the broader market snapshot and what upcoming data is on the radar for those keeping an eye on the economic pulse.
Sure. Globally, European stock indices were mixed, reflecting some of those cross-currents we discussed with the Eurozone inflation data. The FTSE 100 in London was up,
Okay.
but the CAC 40 in Paris and the DAX in Frankfurt edged down. In commodities, gold continued its remarkable ascent,
Still climbing.
hitting its highest levels since late June, now up over 23% year-to-date. Truly a standout performance in a year of market volatility.
Absolutely. And oil.
Oil prices also edged higher ahead of a critical OPEC Plus meeting on July 6th. They are widely expected to announce a modest increase in output, about 411,000 barrels per day next month.
So a small increase expected.
Yeah. That decision will be closely watched for its implications on global energy supply and, of course, gas prices.
And for those keeping an eye on what might move markets today, July 2nd, what should they be looking for? What data points or events could provide the next set of clues?
Well, key data includes the Eurozone unemployment rate, which will give us a fresh look at the health of the bloc's labor market,
Okay.
and speeches from several European central bank officials, including President Christine Lagarde herself.
Her comments will be watched closely.
For sure. Their remarks could offer crucial hints about future monetary policy, especially after hitting that 2% inflation target. There's also a speech by the Bank of England's Alan Taylor offering insights into the UK economic outlook. Yeah.
And stateside.
And here in the U.S., we'll see the ADP Employment Change Report, which is often, a precursor to the government's official jobs report.
Right, the warm-up act.
Kind of. And the Challenger Job Cuts Report, which details corporate layoff announcements. These will provide further crucial clues on the strength of labor markets and potential shifts in central bank policy paths. So definitely worth watching.
It's been an incredibly informative discussion, highlighting the intricate dance between policy decisions, economic data, and the often, unpredictable reactions of the markets.
Understanding these connections is absolutely key to navigating the complex financial landscape. We hope this exploration has given you some genuinely new insights to consider, and perhaps a fresh perspective on the hidden forces at play.
Indeed. As you go about your day, maybe consider this. With governments around the world actively intervening in their economies through massive spending and central banks carefully threading that needle between inflation and growth, what does this tell us about the future role of policy versus pure market forces in shaping our financial destiny?
Yeah, that's a great question to ponder.
It's a thought worth mulling over. Thank you for your attention. You can subscribe to our podcast if you like it. See you next time.